Hello and thank you for joining us here at PhillipCapital Market Watch. I'm Paul Chew, Head of Research with Phillip Securities Research. Today, I'll be talking about our Singapore Weekly Update shared in our weekly Monday webinars. On macro highlights, Singapore industrial production saw an improvement, albeit still contracting 0.4% against a huge 8% fall last month. Bank loans in Singapore were stable and growing at a 2% pace. In headline-grabbing Hong Kong, retail sales fell the most in 3.5 years, but loans growth held up and climbed at an even faster rate of 3.6%. In the Asian region, fiscal spending and more cuts in interest rate will be the key macro themes. Following up on Thailand's massive fiscal spending a few weeks ago, South Korea announced a budget to widen its fiscal deficit. India announced its slowest growth in 6 years and looked likely to cut interest rates further. Our tactical view on Singapore equity market is bearish. There's no reason that the trade war will be resolved anytime soon, and interest rate cuts are unlikely to revive growth. On a top-down basis, the most attractive sector in the current environment are the US REITs listed on SGX. They afford a superior dividend yield, and the US dollar look especially strong against the Singapore dollar on a relative growth basis, plus the MAS is likely to loosen the exchange rate in October. Current RMB weakness is also an overhang on all Asian currencies. This week, we can expect more data on global PMIs and US jobs. The first chart is the modest improvement in Singapore industrial production. Next is Singapore loans growth remains stable. Below is the latest European PMI in green, which enjoyed a recovery this month. The last chart shows the continuous rise in the European Union and US savings rates and lack of consumption post-GFC despite the ultra-low interest rates. This slide features the various pressure points on President Trump to conclude a trade deal with China. His only weakness now is the electoral base in the farming sector, as seen by the rise in delinquent loans and drop in farm incomes. However, the administration is placating this weakness through farm aid and other support measures. Trump is most sensitive to the US stock market, as seen by his constant tweets. But US markets are only just 3% off their highs, so no pressure there. There's no pressure on his approval ratings either, which are relatively stable. Our final slide in the Phillip Absolute 10 model portfolio. What has outperformed for us has been defensives like Netlink and grocery shopping Sheng Siong. Hurting our performance has been banks and property. We are still outperforming the STI this year, and we change our model once a quarter. That's all for PhillipCapital's Market Watch. Tell us what you think in the comments below. Remember to like and follow us on social media and subscribe to us on YouTube. Thank you for joining us and see you soon.